Silver just plunged to $58, and it's not the Iran deal. Here's the real reason. 5 things happened in the same 6 days, quietly, almost invisibly, and not one of them is the story you were told. The Federal Reserve moved first, then a peace deal that 2 countries can't even agree was signed, then a market 8,000 miles away collapsed in a single session. And while every headline pointed at one simple explanation, the real machinery was running underneath, untouched, unreported, and almost completely misunderstood. Because somewhere between Washington and Shanghai, in a vault sitting 6 days from a deadline most investors don't even know exists, a number is quietly running out. And when it does, the price on your screen and the metal in the ground are about to disagree very loudly. Now, before we go any further, I want to ask you for something, not a favor for me, a favor for yourself. If you've been with this channel for a while, you already know we don't do hype and we don't do panic. We do the math, the mechanics, the real chain of events. If that's worth something to you, worth a few extra minutes of clarity in a market that's moving fast, then take 5 seconds right now and hit that subscribe button. Think of it the way you'd save a good newspaper column, so it's there for you next time and the time after that. And while you're at it, tell us where you're watching from today. Drop your city, your country, down in the comments. We'd genuinely like to know who's sitting on the other side of this screen with us. Now, let's get into exactly what happened. On June 24th, silver did something that made headlines around the world. It touched $58. Gold slipped too, falling to $4,058, its lowest point in weeks. Within hours, every major financial outlet had published the same explanation. They said the Iran peace deal had killed the rally. Investors were told the war, fear that pushed silver higher, was gone, so the price came back down. It sounded simple. It sounded clean. But it was almost completely wrong. To understand why, someone needs to look past the headline and into the mechanics of what actually happened that week. Markets rarely move because of one single event. They move because several forces collide at the same time, and most people only see the loudest one. In this case, the loudest story was geopolitics. But the real engine driving the price down was something far less dramatic and far more powerful. It was monetary policy. A week earlier, the Federal Reserve held its first meeting under its new leadership. Markets expected a cautious, balanced tone. Instead, they got something firmer. The committee kept interest rates exactly where they were, between 3.5% and 3.75%. On the surface, that sounds like no change at all. But underneath that decision, something important shifted. The Fed removed any language suggesting it was leaning toward future rate cuts. That single change mattered more than the headline rate itself. Almost half of the committee members signaled they now expect at least one more rate hike before the year ends. Traders reacted immediately. Within days, financial markets were pricing in a real possibility of tighter monetary policy returning, not looser policy easing in. This is the detail most casual investors miss completely. They watch the federal funds rate, see no change, and assume nothing happened. But professional traders don't watch the rate. They watch the direction of travel, and the direction had just reversed. This is where silver enters the picture, not through war, but through arithmetic. Silver pays no interest. It generates no yield. It just sits there, holding its value or losing it, depending on what else an investor could be earning elsewhere. When interest rates are expected to fall, holding silver becomes more attractive because the alternative, cash in a bank account or a treasury bond, offers less competition. But when the market suddenly believes rates might rise again, the competition gets stronger. Yield-bearing assets start looking better. Non-yielding metals like silver start looking less attractive by comparison. At the same time, a stronger expectation of higher rates tends to push the US dollar higher. And there is a long-standing relationship between the dollar and silver. When the dollar strengthens, commodities priced in dollars, including silver, often become more expensive for buyers using other currencies. Demand softens. Sellers step in. The price adjusts downward, not because the metal changed, but because the currency it is priced in changed. So when silver began falling after June 17th, it wasn't because silver suddenly became less valuable as an asset. It was because the financial environment around it shifted. Higher expected rates, a firmer dollar, less appetite for assets that don't pay a yield. This is a mechanical reaction, not a fundamental one. It is the market repricing risk, not repricing silver itself. This distinction matters enormously, especially for anyone trying to understand what is actually happening to their money. A fundamental decline would mean something changed about silver's supply, its demand, or its long-term value. A mechanical decline means the surrounding financial weather changed, and silver, like many other assets, got pulled along with it. These two situations look identical on a price chart. They feel completely different up close. The mainstream narrative skipped over all of this. It was easier to point at a peace deal making headlines than to explain a Federal Reserve meeting buried in financial jargon. But markets do not move on what is easy to explain. They move on what is actually happening underneath. And underneath the silver sell-off, the first and most powerful force at work was not a ceasefire in the Middle East. It was a shift in expectations coming out of Washington. That shift explains part of the picture, but only part. Because while the Federal Reserve was tightening the financial weather, another story was unfolding in parallel, one involving a peace deal that may not be as settled as the headlines suggested at all. You said, with part 2, start more unique 800 words. While markets were busy blaming a peace deal for silver's decline, a strange detail went almost unnoticed. The two sides of that peace deal couldn't agree on what they had actually signed. On June 23rd, one government publicly announced that the agreement included full and complete nuclear inspections, far into the future. It sounded definitive. It sounded like the kind of statement that ends a conflict and removes risk from the world overnight. Hours later, the other side told reporters something very different. Officials there said nuclear matters had not been discussed in detail at all during the talks, and there were no plans to allow inspectors back into their facilities. Two governments, one supposed agreement, two completely different descriptions of what it contained. This is not a minor footnote. It is the foundation the entire peace deal explanation was built on, and that foundation was already cracking in public, in real time, reported by multiple major outlets, within a day of the deal being celebrated as the reason silver fell. A market does not usually crash an entire metal's price over an agreement that one of the two signing parties is actively disputing. Something else had to be doing the heavier lifting. To understand why this mattered so much, it helps to look at oil first, because oil is what actually moved on the peace deal narrative and silver got pulled along in its wake. Oil had fallen sharply in the months leading up to this, dropping more than a third of its value as traders priced in a future where shipping lanes stayed open and regional tension faded. That pricing only makes sense if the peace holds. If the nuclear dispute escalates instead of resolving, the entire basis for cheaper oil disappears, and energy markets would need to reprice almost overnight. Adding to that fragility, strategic oil reserves were sitting at their lowest level in over 4 decades, leaving almost no cushion if disruption returned. None of this had fully played out yet, but the uncertainty alone was enough to create nervous, fast-moving capital across commodities, silver included. At the very same time, a second and entirely unrelated force was building. It had nothing to do with Iran, oil, or interest rates. It was simply the calendar. Large institutional investors, the pension funds, asset managers, and big money pools that move markets were approaching the end of the second quarter. The quarter end is not optional for these institutions. Portfolios must be rebalanced. After a long rally in stocks, many of these funds found themselves holding more risk than their internal rules allowed. The fix is mechanical. Sell something liquid, bring the portfolio back into balance, and do it before the deadline. Silver, traded constantly in massive volume, is exactly the kind of asset that gets sold in moments like this, not because anyone disliked silver specifically, but because it could be sold quickly and easily. Then came the third force, arriving almost like an accident colliding with two unrelated cars at the same intersection. On June 23rd, South Korea's stock market suffered the worst single-day decline in its entire history, falling close to 10% in one session. Trillions of dollars in value disappeared within hours. The trigger was surprisingly specific. A financial regulator publicly expressed regret over approving a wave of leveraged investment products tied to major technology stocks, products that had attracted enormous retail money during an earlier rally. The moment that regret became public, leveraged investors faced sudden margin calls. They needed cash immediately, and when investors need cash immediately, they sell whatever can be sold fastest, wherever in the world that asset happens to trade. That panic did not stay contained in Seoul. It moved, the way financial stress always moves, into anything liquid enough to convert into cash on short notice. Silver, again, fit that description perfectly. It had nothing to do with Korean technology stocks, but it shared one trait with them that mattered more than fundamentals in that moment. It could be sold instantly, in size, anywhere in the world. Put these pieces together and a very different picture forms than the one in the headlines. A disputed peace deal creating energy market uncertainty. A calendar deadline forcing institutional selling. A foreign stock market collapse triggering forced liquidation far beyond its own borders. 3 separate events, 3 separate causes, arriving in the same narrow window of days. Silver wasn't reacting to its own story. It was absorbing shockwaves from 3 other stories entirely, all because it happened to be one of the easiest assets in the world to sell when cash was suddenly needed. This is how a liquidity cascade works. It does not ask whether an asset deserves to fall. It only asks whether that asset can be sold quickly. And for a few critical days, silver could. While the paper price of silver was collapsing toward $58, something almost contradictory was happening on the other side of the world. In China, the largest physical silver market on the planet, buyers were paying nearly 10% more than the London paper price just to get their hands on real physical metal. This detail deserves to be sat with for a moment because it does not fit the panic narrative at all. If the underlying story of silver had genuinely changed, if the metal's future demand or scarcity had weakened, physical buyers would not be racing to pay a premium for it. They would be waiting, like everyone else, for the price to fall further. Instead, the opposite was happening. While Western paper markets were selling silver they mostly never touch, never store, and never deliver, buyers in the physical market were doing the one thing a falling, broken asset rarely attracts. They were stockpiling it at a premium. That divergence becomes even more revealing when looking at the warehouses that actually back the paper contracts being traded. The exchange responsible for settling those contracts reported just over 86 million ounces of silver formally registered and available for delivery. That number matters because it represents the only silver that can legally satisfy a futures contract, demanding physical metal rather than a cash settlement. Against that available supply sat a much larger number. Nearly 40,000 contracts for the next delivery month remained open, and each of those contracts represents a claim on 5,000 ounces of silver. Multiply that out, and the paper claims with a legal right to demand physical delivery added up to almost 197 million ounces, more than double what was actually sitting in the vault. The coverage ratio, the amount of real metal available compared to the paper claims against it, sat at roughly 16%. Historically, once that ratio drops below 15%, the market is considered to be entering serious stress. It was sitting one step above that line, just days before the delivery window opened. This is the part of the story that almost nobody discussing the Iran deal or the Federal Reserve was talking about. A market can print any price it wants on a screen. That price reflects whatever traders are willing to pay for a piece of paper representing silver. But eventually, someone holding that paper wants the actual metal, and at that point, the paper price and the physical supply have to reconcile. Throughout history, whenever these two figures have diverged sharply, it has always been the paper price that eventually moved to match physical reality, not the other way around. None of the structural numbers behind silver's long-term story had shifted either. Industry researchers tracking global supply and demand had already confirmed, just months earlier, that the world was heading into its 6th consecutive year of more silver being consumed than mined or recycled. That shortfall does not disappear because a stock market in Seoul had a bad trading session. The factories building semiconductors, electric vehicles, and solar panels did not suddenly find a substitute for silver's conductivity in the span of one volatile week. Industrial buyers were not canceling years of supply contracts because retail traders in leveraged products got margin calls. There is one more number worth understanding here: the relationship between gold and silver themselves. For decades, these two metals have traded within a fairly consistent ratio to one another. When gold becomes dramatically more expensive than silver, history shows that imbalance rarely lasts. It has only happened a handful of times in the past several decades, and on each occasion, silver eventually closed that gap, sometimes dramatically. At the moment silver touched $58, that ratio had stretched to one of its widest levels in recent memory. A level that, in the past, has marked exhaustion rather than the beginning of a new trend. Put simply, the paper price was reacting to fear, leverage, and forced selling. The physical market was reacting to something else entirely: scarcity. And when those two forces disagree this sharply, the physical side has historically been the one telling the truth. With the mechanics of the sell-off laid bare, the real question becomes simple. What happens next? And the honest answer is that two very different paths remain open, both grounded in real possibilities, not speculation. The first path is the recovery scenario. It begins with a disputed peace agreement actually holding together, even imperfectly, over the following weeks. If both sides stop contradicting each other publicly, and the ceasefire framework survives its early test, oil prices stabilize rather than spike. That removes one major source of inflation pressure. If the Federal Reserve then delivers only a single rate hike later in the year, instead of the 2 hikes the market had begun pricing in, real yields stop climbing. The dollar, which had pushed toward a 1-year high, loses its momentum and begins to soften. Under this path, the conditions that mechanically pushed silver down begin to reverse, one at a time. A market sitting on a confirmed multi-year supply deficit, a widened gold-to-silver ratio, and a stressed physical delivery system does not need a dramatic catalyst to move higher again. It simply needs the pressure that pushed it down to ease. The second path is the continuation scenario, and it deserves equal honesty. If the nuclear inspection dispute escalates instead of resolving, and shipping routes through the region face real disruption, oil could spike toward $90, especially with strategic reserves sitting near historic lows. That kind of energy shock would re-accelerate inflation readings in the months ahead, giving the Federal Reserve justification for 2 rate hikes rather than 1. Real yields would climb to multi-year highs, and the dollar would likely extend its rally. Under this path, silver could see further downside, with technical levels in the mid-50s, or even lower becoming realistic targets. This is not a remote possibility. It is a coherent chain of events that responsible analysts have to account for. What separates a serious market participant from a reactive one is not predicting which path occurs. Nobody can do that with certainty. What separates them is knowing which indicators to watch while the answer unfolds. 3 numbers matter more than any single day's price movement. The first is the registered vault inventory backing delivery contracts, watched daily. If that number continues declining while contract demand stays elevated, physical stress is building in real time. The second is the open interest heading into the delivery window. If it remains high rather than unwinding quietly, it signals genuine delivery demand, not speculative noise. The third is the dollar index itself. Since a strengthening dollar has been the single most consistent mechanical force behind this entire decline, its behavior in the coming weeks will reveal more than any analyst commentary could. For the business-minded observer, the lesson extends beyond silver itself. Markets regularly punish assets for reasons that have nothing to do with their underlying value, simply because forced selling, leverage unwinds, and calendar-driven rebalancing do not discriminate between good and bad assets. They only care about liquidity. Recognizing the difference between a structural reversal and a mechanical temporary correction is not a skill reserved for traders. It is a discipline available to anyone willing to look past the headline and into the numbers underneath it. Major banking institutions had already published year-end targets for silver well above where it now traded, built on fundamentals that had not changed during this turbulence. Whether those targets prove accurate depends on which of the 2 paths the world chooses to walk down in the months ahead. The mechanism has been explained, the indicators have been identified. What happens next will be written in the data, not in the headlines.